I'm going to try as much as possible to break down what market structure is and to make it much more easy for those that are finding it difficult to understand the concept behind market structure. And before we proceed, I would quickly like to run us through what we are going to learn in this video section or in this class. So firstly, we are going to demystify market structure in terms of definition and everything relating to market structure on its own. After that, we are going to proceed to market structure formation, which is how market structure is being formed. Then we're going to move to break of structure and understanding market structure shift or change of character. So when we finish that, we are going to wrap up this class with understanding the impulse and correction concept, which is the concept of impulse and correction. Without wasting much of your time, let us get started with what market structure is. So as you can see on my screen, market structure basically describes how price moves and the behavior of the participant. So whenever you are in a chart, be it a crypto market, be it a forex chart, so it is market structure that would explain to you the behavior of the market condition in terms of maybe the market condition is to the upside or the market condition is to the downside. So we don't have any reason to complicate what market structure is. That is the reason why I give it a very simple definition by stating that market structure basically describes how price moves and the behavior of the participants. You may now want to ask yourself that who are the participants? The participants in the forex space is, let's say, the banks, the hedge funds, and people like you and I that happens to be the retail trader. So we are the participant. And when we open a chart and through market structure, we'll be able to know what those participants, what they are engaging in. Are they trying to push the market to the upside, or they are trying to push the market to the downside? So with the help of market structure, we'll be able to figure out that. I think I have made myself clear on that definition. So let's move to the other paragraph, which says when price moves continuously in an upward direction, such upward movement is called the bullish or uptrend movement. What this simply means is, when we said earlier on that market structure tells us about how price moves and the behavior of the market participant. So in a situation whereby you open a price chart, I am still going to go to the chart to show you the live example of all this my explanation. So when you go to the chart and you find out that price is pushing, or the participant are pushing price towards the upside, so that kind of movement or that kind of action or behavior that the market participant exhibits happens to be what we call, or what we know as, a bullish or uptrend movement. So the same thing goes to when you notice that price is being pushed towards the downside. So such movement or such action is known as the bearish or downtrend movement. So in a nutshell, that simply means that we can only have two participants within the market, which is the bull or the bear. It's either the market is going towards the upside or the market is going towards the downside. So we are going to move to the next paragraph that said when price remains stagnant or capped within a certain region without a clear movement, it is called a ranging or consolidation consolidating price movement. What does that mean? It means that if price is not going towards the upside and price is not going towards the downside, and probably maybe price happens to be stagnant within a particular range, let's say within a particular high and a particular low. Price is not moving above or below that particular spot. Such movement is called a ranging or consolidating price movement, meaning within that period of time we cannot really identify what the participants are doing. So meaning the market is not controlled by the bull and also is not controlled by the bear. They have, let's say, an equal strength within the price chart. So that is the reason why the market or the price is being capped within a specific high and a specific low. So the bulls will try to push the market to the upside and the bears will try to push the market to the downside. I think I have made myself clear on the subject matter of market structure. So now we are going to move into how market structure is being formed. Since we have understand that market structure can either be to the upside or to the downside, so we need to understand how that kind of structure is being formed, and that is going to lead us to market structure formation. And within the market structure formation, we have 3 paragraphs or 3 subheadings which we are going to talk about. So the first one is how the bullish market formed. How is it being formed? So the bullish movement structure consists of higher highs and higher low. We said the bullish movement structure formation consists of higher highs and higher lows. So look at this edge here. Look at this edge where I am pointing my mouse to. So this is a high and this is another high. So this high is higher than this previous high. So this place is a higher high. This place is a higher high. So when we have this kind of formation whereby the current high is higher than the previous high, if we have something like that consistently or continuously rather, so such formation is what we call the bullish movement structure. So the bullish movement structure consists of higher highs and higher lows. This is a higher high, this is a higher high, this is a higher low, and this is a higher low as well. So when we get to the chart, you will definitely see the live example of how this works in the chart. And one thing I want you to also understand is the bearish movement structure formation consists of lower lows and lower highs. Looking at this picture as well, which is to this side, you are going to see that the low here is lower than this previous low. So when we have price pushing towards the downside like this continuously, it will continue to give us a low that is lower than the previous low. So in a consolidating market, just like we have said, in a consolidating market is being capped within a particular high and a particular low. So when we get to the chart, I am going to explain much more better to you on that. So without wasting much of our time, let me show you a chart example of the bullish structure and the bearish structure. So this is a synthetic chart, volatility 75 synthetic chart. So I'll be using it as an example to show you how market structure is being formed. So just like I have explained that the bullish movement structure formation consists of higher high and higher low, and also the bearish movement structure formation consists of lower low and lower highs. So let's take a look at this volatility 75 index chart on a daily time frame. So I want you to focus on this area. If you look at this entire chart very well, so it is obvious to you that this chart has been in a down or has been making a downward movement. So just as you can see, the movement kickstart from this edge up to this point. So now if we said the bearish movement consists of a lower low and lower high. How are we going to identify this low, and how are we going to identify any high? So if you look at this point, this movement very well, you are going to observe that this is a low. This point here is a low. This point here is also a low. This point here, let's say all this point here is a low. This low is lower than this low. This low is also lower than this low. So with this, we can say we have a bearish movement trend. So if we want to make it more simple, look at this edge as well. Look at this low here. We have this low here. We have this low here. We have, let's say, this low here. We have also this low here. So this low is lower than this low, and this low here is lower than this low. This last low is also lower than this low. So within this point to this point, we have also a bearish movement here that is very clear to us. So, and we can call this low a low, and this one that is lower than this one is a lower low. And if we have another low that is lower than this low here, that one will be our new lower low. And this high will be, we will have a lower low, a lower high, a lower low here, and this is our lower high, because this high is lower in high than this lower high here. So this makes this high our current lower high, and this one will be our previous lower high. So in a situation whereby we have a new low that is lower than the previous low, the high will now become our lower high, while the new low will become our lower low. So the same thing still goes to the bullish aspect of it. You just have to inverse it. So that, I think this little explanation explain everything regarding what I have said in the theoretical aspect to you. So this is the currency pair chart, GBP card currency pair chart. So I want to use this pair to explain the formation of the bullish movement market structure. So, and I could remember from the theoretical aspect of it, I said the bullish movement consists of the higher highs and higher low. So if you look at it, the price has been going, let's say, it has been moving to the upside. So we just have to understand the market structure. So if the price has been pushing to the upside, and we know that the bullish movement consists of the higher highs and higher lows, how are we going to mark out the highs now? If you look at this point here, if you look at this point, you will see that this high is kind of, this is another high. Let's put it this way. So this is also another high. So, and you can say we have another high here. So if you look at this last high, you can see that it's higher than this previous high, and the same thing goes to this high is higher than this previous identified high, and also this high is higher than this previous identified high. So this happens to be a high, a higher low, because this high, the low is lower than this one. So we have a high, a higher low, and since this high is higher than this one, we have a higher high, and this point will now be our higher low. And since we now identify that there's another high that is higher than this previous high, so that new high becomes our higher high, and the low after the high formation happens to be our higher low. And if price creates another high that is higher than the previous one, we now have a new higher high. So with this explanation on the screen, I think you should be able to understand how the bullish market structure is being formed, just like I have explained. So this is a high, and we have a new high that is higher than the previous high, giving us a higher high, and this also becomes a higher high to this one, and this one also become a higher high to this one. So with all this that we have been able to mark out, identifying all these highs that are higher than the previous one, we can say that the market participants in this forex chart now are the bulls, because the price is pushing towards the upside, and we have been able to identify how it is being formed or how it was formed. So that is all about the explanation regarding market structure formation. So we are going to continue our class with the subtitle or subheading, break of structure and market structure shift. So you know how we do it. We are going to read the theory aspect, then we'll proceed into looking at the chart example. So now let's start from the first line. When price breaks through the previous high with a candle body close in a bullish movement, it is called break of structure to the upside. And when price breaks through the previous low with a candle body close in a bearish movement, it is called break of structure to the downside. In a situation whereby we have an already established upward movement and suddenly price breaks through the previous created low with a candle body close, that signifies a reversal in the upward movement, and such act is usually tagged as market structure shift. So for as much as some people call it market structure shift, some other people call it change of character. So it still means the same thing. When price breaks through previous high and with a candle body close in a bullish movement, it is called a break of structure. If you look at this diagram here, which is the uptrend showing break of structure, don't forget that I made you understand that the formation of a bullish movement consists of a higher high. This is a higher high, and we'll have a higher low. And when we have a new high, that new high that is higher than the previous high is our new higher high, and this will become our new higher low. So when price pass through or moves, as price is moving after the creation of this high, and we have this higher low, and price continue to move to the upside, the moment price breaks through this high, this region, with a body of a candle close above this area here, we'll call that action a break of structure. And that is the reason why you have this. That is the reason why you have this BOS, which means a break of structure. So you can see with this illustration, price moves from this low again, and price continue to move, and the moment price pass through this previous high with a body candle close, we said that action is a break of structure. And a break of structure signifies that price still have the interest of going towards the upside or moving towards that particular direction, be it a bullish direction or a bearish direction. And if you look at this scenario as well again, this happens to be our newly created high, which is our new higher high, and we have this as our recent higher low. So price continue to move towards the upside, and the moment price cross this higher high or newly created higher high with a candle body close again, we said we have made a break of structure, Same thing goes to the bearish aspect of it, which is the downtrend of it. You can see we have this low here and we have this lower low, which is lower than the previous low. So and price moves to the upside, and the moment price continue to push to the downside and crosses below this point of lower low with a body candle close, we will say to ourselves that such action have created a what we call break of structure to the downside, and the same thing repeats itself. And if you look at this last one, happens to be we have a downtrend here because we have this low, and there happens to be a break of structure here because it passes through the previous low, creating another new lower low, and we have a lower high, and price continuing to move to the downside. And the moment price, let's say the candle passes through this junction, this lower low junction with a body candle close, we said we have another break of structure, and this is our lower high, and price continue to move to the upside. The moment price breaks through the last lower high in a bearish direction, that is a signal that is a signal that price may no longer interested in going towards this bearish direction, that price is willing or may likely change its direction. And that is why the definition here states that in a situation whereby we have an already established upward movement, in this situation now, the already established movement here is a downtrend because we have a lower low, and lower low, and suddenly price breaks through the previously created lower high. This happens to be the last lower high, and the moment this movement breaks through this previously created lower low, that action is called a market structure shift. If you look at the movement here, the movement has been a bullish market structure, and this is the formation. We have this high here, we have this high here, we also have this high here. So this high is higher than this previous high. Also this high is also higher than this previous high. So from this point up to this point is obviously to us that the market has been bearish, has been bullish. So if you look at this low, we have this low, we also have this low here, we also have, let's say, this low here. So meaning we have a high, a higher low, a higher high, a higher low here, a higher high, and a higher low. And all these things that is happening here, price move from this point, this is a high. So the moment price move, like in the definition we said, the moment price crosses above this area here, let me remove this one. The moment price crosses above this high here, this high with a candle body close, this is a candle, this green candle, this candle crosses above this high and closes with a full body. So this is where our break of structure happens. So we said we have a break of structure to the upside. So the same thing also goes to this point here. This is our high, and this candle here, this candle I am pointing to happens to be the candle that signifies that there is a break of structure, because this candle body actually close above this high here. And in this high, in this last high, we were unable to see a break, so there is no break. But what we can observe is we have this high, we have this low here. This is our low. So price was now coming down. So when price was coming down, price break through it breaks through higher low with a bearish candle close. With this candle actually breaks with a body. So this action here is what we call market structure shift. So this is where our market structure shift happens. And if you look, the moment we have this market structure shift, price rally to the downside, come down, come up again, and the next thing we see is price push to the downside. So price has been in a bullish market condition here, and this market structure shift now is a signal for us. When this happens, it has signaled to us that price may likely not continue in this bullish movement. Instead, it may now reverse towards becoming a bearish movement. And what you can see thereafter, we see price crash to the downside. So from a bullish market structure into a bearish market structure, it will give a series of higher highs and higher low. So in order to give you clarity, let's look at it. We have a high here, price give us a high here, we have another high here, we have this high here, we have also this last high here. So with that, we have been able to identify that truly price has been in an uptrend, starting from this point up to this point. So, and when price is in an uptrend, so it will continue to give us a break of structure to the upside. So this is our break of structure here. So this bullish candlestick crosses above this high here, crosses above this high here. So that is a signal for a break of structure to the upside, and the same thing happens at this point here also. So this candlestick here close with a body above this high here. So that is how we were able to establish our break of structure to the upside. So we have another break of structure here, and we're unable to make a new break of structure. And don't forget, this point happens to be our last higher low. So when price was now coming down, we can see that this bearish candle closes below this our previous higher low. So when such situation happen, we said we now have a market structure shift, which is a signal to us that price may likely not go in the bullish direction again. So, and thereafter, what did we see? We see price crashing to the downside. So price continue to crash to the downside, giving us a new low here. We have a new low here, and we also have this new low as well. So this is another example of break of structure and market structure shift using the GBP USD chart. And I think with these two explanations, you should be able to go on any chart as well to identify your break of structure and to identify your market structure shift. So I am going to give you a cheat code on how you can easily identify the point of break of structure or the point of market structure shift. So I want you to remember this is a drawing, or this is an alphabet of V for violin. So whenever price is pushing to the downside, this point here, which is this point of V, this sharp edge here, whenever you have candle or a group of candle that forms this V shape, just like you can see here. We have this V shape here. Let me draw it out. You can see we have this V shape. If I bring it out, you will see that we have this point here. So if price is coming down, this happens to be our point where we will look into. If for any reason that price breaks through this sharp point of the V to the downside, that is a point of break of structure. And if to the upside, we are going to look into the inverse of the V. So when price is breaking structure to the upside, it will create a point like this, an inverse V. This is an inverse V, and this is the normal alphabet V. So when price creates something like this, and we have this sharp edge of the inverse V, so that is where we will mark out. So whenever price is going up, pushing up, and the moment it crosses this sharp V, this sharp area of the inverse V, or sharp area of the normal V, that is where we want to see our indication for break of structure or market structure shift. And mind you, one candle cannot form this. You need a group of candle to form this. So I need you to go on your chart and identify this V shape and the inverse V. If you are able to identify this V shape and the inverse V, it will be easy for you to mark out your market structure, which is in terms of break of structure and market structure shift, even in a little or tiny form. So if you look at here, you can see we have the small V. If I bring it out, you see this is the sharp edge, and if you look at it carefully, you can see. So we have a break of structure here, then we have another V formation again. If you look at it, regardless, excuse me. So let me try as much as possible to draw it back. So if I bring this structure out, you can see this is a V. This is a V. So we may call this point also another minor break of structure. And if you look at this point, we have this push to the upside like this. So if I bring the diagram out, you are going to see, forget about, let me redraw it. Let me just draw it back again. So when you see something like this and something like that, if I bring it out, you are going to see that we have like the inverse V, and this is the sharp edge. And if you look at it from here, we have market structure shift to the upside, because we have been making a lower low, lower high, a lower low, and price breaks through the sharp edge of the inverse V, which is this one here. It breaks through with this green candle here. That is where we have our break of structure. So this one happens to be the major. You see, this one is major because it is massive, while all this tiny one is what I can call the minor break of structure or minor market structure shift. So you have to learn how to identify this V shape and the inverse V shape. So if you can identify it on the chart, marking out your break of structure and marking out your market structure shift will be as simple as share it, turn on the notification button so that whenever I release my subsequent video, you will be the first person to get notified on that. Subscribe, share, like, and also leave your comments on any video you want me to create. We are going to wrap up this class now with what I called the impulse and correction. So we have impulse and correction. So if you observe very well, this is a diagram showing uptrend, and you already know that when price breaks through or crosses the recent high and breaks through the recent high with a candle body close, that is a break of structure. So that movement that breaks through the high is what we call the impulse, and the movement that occurs after the impulse is what we call correction. And that is why I put it that the concept of impulse and correction can be synchronized with the word expansion and contraction. So meaning that price do not just go straight. Price breathes in and breathes out, breathe in and breathe out, expand and contract. So when price breathes in, that is what we call our correctional phase, and when price try to breathe out, which is expand, that is what we call the impulsive movement. So jump 100 in this chart. I will be using this chart to explain the impulse and correction concept. So let's go into it. If you look at this chart from this edge up to this point, what direction can you see? What direction can you see? I want you to put it at the comment section, the direction you can see. So that will indicate to me that truly you understand everything which I have put together in this video section. Welcome back once again. I know each and every one of you maybe would have put the bearish direction. If you put the bearish direction, definitely you are right. So price has been bearish, and we already know that when price is bearish, it forms what we know as the lower low, lower high of a thing. So let's try and, so this is one low, this is another low, as you can see, and just like that. So just like that, as you can see. So it's very simple, just like that. So this is an indication that truly this price has been in a bearish directional movement. So now I explained to you from the theoretical aspect of it that price do what we call the breathing in and the breathing out. So when price breathes out, that is what we call the expansion phase, and such expansion is the impulsive movement. And when price breathes in is what we call the correctional movement, because price, you can see that when price want to move from this point here up to this point, it does not just go in one straight line. It doesn't go in this straight line format. Price was going in a format of breathing in and breathing out. So you can see, let me map it out. You can see price move this way. It breathe out, breathe in, breathe out, breathe in. Price breathe out again, it breathes in, breathe out here, breathe in, breathe out, breathe in, and finally breathes out. So the process of this breathing out is the impulsive movement, and the process of breathing in is the correctional movement. So breathing out, impulsive, breathing in, correctional movement. So when you have situation like this and you are trying, although this class is not on how to take trade, but I just want to clear something. So when you have a situation like this whereby price is in a downtrend and price is breathing in and breathing out, you don't want to participate in the market when it is breathing out. You want to participate for a sell when the price chart or when the price has breathed in. So when it has breathed in and you see your signal, or you saw the signal that it is time for price to breathe out, that is when you want to join the price to go in the direction of the impulse. So when price is making impulse, you don't do anything. You wait for price to breathe in, which is make a correction, and after which the correction has finished and you see that price is ready to make a new breathing out, which is a new impulsive movement, that is when you will join price to go in that direction of the impulsiveness. So I think everything I have explained in this video, I think you all understand it. So if you understand it, I want you to go to your chart and check all these things out yourself. Look at many other currency pairs. Try to use this little concept which I have explained to understand the market structure yourself, to mark out if a particular currency pair is moving towards the downside or is moving towards the upside. Thank you very much for your time. Thank you for your energy. Thank you for supporting this channel, and I hope in my subsequent video you are going to learn what I call the advanced market structure, because this is just the simple market structure. So there are more technical or much more advanced way which the market move, but this is just the simple market structure. So in my subsequent video or in my next video, I'm going to put together another video that is going to show you how the advanced market structure works and how you can use that to your advantage. Till we meet next time, enjoy yourself and remain positive. Goodbye.